Why prices can crash during the Shanghai holiday window. What it means next. Why prices can crash during the Shanghai holiday window. What it means next. February 2025. The world's largest physical gold market just went dark for 9 days. While most investors sleep, a pattern is repeating. The same pattern that preceded every major price dislocation in the past 5 years. Shanghai closes, Western paper markets take control, and something always breaks. This isn't theory. This is documented, measurable, and happening right now. The question isn't whether prices will move. The question is, who understands what's actually happening? And who gets caught on the wrong side of the trade? Welcome to Financial Crisis Explained. If you've been following markets long enough to remember when fundamentals actually mattered, when a handshake meant something, and when understanding the system gave you an edge, then you know why you're here. We don't do entertainment, we do analysis. This channel exists for one reason, to help serious people understand serious market dynamics before the crowd figures it out. So here's what I'm asking. If you value clarity over noise, if you'd rather understand the chessboard than chase headlines, subscribe to this channel, hit that button. It takes 2 seconds, and it ensures you don't miss the next piece of this puzzle. Also, drop a comment right now and tell me, where are you watching this from? New York, London, Singapore, Mumbai? Let me know. I want to see who's paying attention. Now, let's get into what's actually happening. Every year, like clockwork, a specific window opens in global financial markets. It lasts approximately 9 days. During those 9 days, the world's largest physical precious metals exchange goes completely silent. No trading, no price discovery, no physical settlement. The Shanghai Gold Exchange, the single most important venue for actual metal changing hands, simply shuts down. And every single time this happens, something moves in the price action that doesn't quite add up. This isn't speculation. This is observable, documented, and repeating with statistical regularity that should make any serious market participant pause and ask the uncomfortable question, is this pattern exploitable? Let's establish the facts first. The Shanghai Gold Exchange handles more physical gold volume than any other exchange on the planet. Not contracts, not paper promises, actual metal, bars that get loaded onto trucks, vaults that get opened and closed, real settlement. When Shanghai closes for the Lunar New Year holiday, that physical demand signal, the thing that grounds price in reality, disappears from the global market for over a week. Now, in a perfectly efficient market, this shouldn't matter. Other exchanges remain open. COMEX in New York, LBMA in London, Tokyo, Zurich. The network is global, decentralized, redundant, except markets aren't perfectly efficient. And what happens during these closure windows tells a very different story. February 2024, Shanghai closed February 10th through February 18th. Gold prices dropped 4% in 6 trading days, not gradually, sharply, with unusual volume spikes at specific overnight hours when Asian physical buyers would normally provide support. February 2023, Shanghai dark from January 21st to January 27th. Gold fell nearly 3%. Silver dropped harder, 7% in the same window. February 2022, closure from January 31st to February 6th. Gold declined 2.8%. The pattern held 3 years, 3 holiday windows, 3 directional moves, all in the same direction. Correlation doesn't equal causation. But when correlation repeats with this consistency, ignoring it becomes negligence. Here's what makes this particularly interesting. These aren't random price movements tied to some new Federal Reserve announcement or geopolitical shock. These are moves that happen during the void, during the window when the largest physical price anchor in the system is offline. The mechanism is simple, even if uncomfortable to acknowledge. Gold and silver trade in 2 parallel universes, physical and paper. Physical markets involve actual metal, refineries, vaults, transportation, settlement that requires trucks, security, and warehouse receipts. This market moves slowly. It has friction. It has limits. Paper markets involve contracts, futures, derivatives, promises to deliver metal at some future date. Though statistically, less than 2% of these contracts ever result in actual metal changing hands, paper markets move fast, infinitely fast. You can create $1 billion in synthetic gold exposure with a keystroke. Under normal conditions, arbitrage keeps these 2 universes aligned. If paper prices drift too far from physical reality, traders step in. They buy the cheap one, sell the expensive one, and pocket the difference. That mechanism keeps the system honest, but arbitrage requires both markets to be open. When Shanghai goes dark, when the dominant physical price setter disappears, that arbitrage mechanism weakens. And in that weakness, a window opens. Western futures desks can move prices more freely. There's less physical pushback. Fewer buyers stepping in to say, that price doesn't match what I'm seeing in the real world. The data supports this. Average daily price volatility during Shanghai closure periods is 38% higher than during normal trading windows. Intraday price swings widen. Volume concentrates in off-hour sessions when physical market participants are asleep. This isn't chaos. This is structured opportunity. And the question every serious market participant needs to answer is this: who benefits from volatility during a liquidity vacuum? It's not retail buyers checking their portfolios once a week. It's not pension funds rebalancing quarterly. It's the participants who understand the calendar, who know when the physical anchor disappears, and who position accordingly. February 2025 presents the same setup. Shanghai closed February 10th. It reopens February 19th. Right now, as this analysis is being recorded, we are inside the window. The question isn't whether prices will move. The question is whether you understand why they're moving and what that means when the physical market comes back online. Because history shows that when Shanghai reopens, price reconciliation happens fast, and those caught on the wrong side of that reconciliation don't get a second chance. There's a reason most people don't understand what's really happening in precious metals markets. It's not because the information is hidden. It's because the system was deliberately built in layers, and most participants only ever see one layer. They see a price ticker. Gold, $1,900 per ounce. Silver, $22 per ounce. Clean, simple, singular. But that single price, the one everyone watches, is actually the output of three completely different machines running simultaneously, each with different rules, different participants, and different endgames. And when one of those machines shuts down, even temporarily, the entire pricing architecture shifts in ways that aren't immediately visible to anyone not watching the foundation. Let's pull the system apart. Machine 1, the physical settlement market. This is Shanghai. This is the vaults in Zurich. This is the refineries in Perth and the dealers in Dubai moving actual metal across borders. This machine runs on gravity. It's heavy, slow, governed by the laws of physical reality. You can't create gold with leverage. You can't margin call a gold bar into existence. You can't print more silver because a computer says you need it. Physical markets are constrained by supply, mining output, refinery capacity, vault space, transportation bottlenecks. When someone buys gold in Shanghai, they're not buying a promise. They're buying a bar with a serial number that gets loaded onto a truck and delivered to a vault with their name on it. That transaction creates real price discovery because it reflects real scarcity. If there isn't enough physical gold available at a certain price, the price has to rise until someone is willing to sell. There's no escape hatch, no synthetic substitute. This is the machine that grounds the entire system in reality. Machine 2, the futures and derivatives market. This is COMEX. This is the London forward market. This is where institutions, banks, and hedge funds trade contracts representing gold, not gold itself. This machine runs on velocity and leverage. A single participant can control exposure to 10,000 ounces of gold with a fraction of the capital required to actually own 10,000 ounces of gold. The system allows this because, statistically, almost no one ever takes delivery. They close their positions before expiration. They settle in cash. They roll contracts forward into the next month. The futures market exists, theoretically, to provide liquidity and price discovery for producers and consumers who need to hedge real-world exposure. But in practice, the futures market has become something else entirely. It's become a battlefield for directional bets, a place where billion-dollar positions can be established and unwound in milliseconds, where prices can be moved not by supply and demand for actual metal, but by positioning, sentiment, and leverage. And here's the critical point. Futures markets can, for short periods of time, decouple from physical reality. They can trade at prices that don't reflect what's happening in the real world, as long as arbitrage players don't step in to correct the disconnect. But arbitrage requires both markets to be functional and accessible. Machine 3, the London bullion market. This is the over-the-counter wholesale market, the place where central banks, sovereign wealth funds, and major institutions transact in size. London operates in a gray zone between physical and paper. Transactions are settled as unallocated accounts, meaning buyers don't own specific bars. They own a claim against a pool of metal held by a bank. It's more physical than a futures contract, but less physical than a bar in your own vault. London acts as the bridge between the purely physical world and the purely synthetic world. When all three machines are running, when Shanghai is pricing physical, COMEX is pricing futures, and London is intermediating between the two. The system stays relatively balanced. Arbitrage works. Discrepancies get corrected. If COMEX gold trades too far below Shanghai's physical premium, traders buy COMEX contracts, take delivery, and ship metal to China for a profit. That mechanism keeps the machines synchronized. But remove one machine from the equation, specifically remove the largest physical machine, and the synchronization breaks. Suddenly, futures desks in New York aren't constrained by what's happening in physical vaults. They're trading in a market where the normal feedback loop, the thing that says your price is wrong because real buyers aren't showing up, is temporarily offline. This is not theoretical. In February 2024, during the Shanghai closure, COMEX open interest spiked by 12% in 72 hours. Massive short positions were established at prices that would have been immediately challenged by physical buyers if those physical buyers had been active. But they weren't. They were celebrating the Lunar New Year, and by the time they came back online, the price had already moved. The futures market had established a new reality, and physical buyers had to either accept it or fight their way back. This is the architecture. 3 machines, 3 different rule sets, 3 different participant bases, and when one goes dark, the other 2 don't just continue business as usual. They recalibrate in ways that favor whoever understands the temporary imbalance. The question isn't whether this structure exists. The question is whether you're trading aware of the structure or blind to it. Because the players who understand the architecture, the ones who know when machine 1 shuts down and what that means for machine 2's behavior, those are the players who don't panic during volatility. They position for it. Let's talk about something most market commentary carefully avoids. Intentionality, not conspiracy, not manipulation in the Hollywood sense of shadowy figures in a smoke-filled room controlling everything, but tactical awareness. The recognition that certain participants in the market have better information, better positioning, and better timing than others, and that they use structural advantages when those advantages present themselves. This isn't controversial in any other market. Everyone acknowledges that high-frequency trading firms exploit millisecond advantages. Everyone knows that insider information gives certain players an edge before earnings announcements. Everyone understands that central banks moving interest rates create predictable ripple effects that sophisticated desks position for in advance. But mention that the same dynamic might exist in precious metals markets during known calendar events, and suddenly it's treated as fringe theory, except the data doesn't care about comfort levels. The data shows a pattern, and patterns that repeat with statistical significance aren't accidents. They're strategies. Let's examine what actually happens during these Shanghai closure windows. Not through the lens of theory, but through the lens of observable institutional behavior. February 10th, 2025, Shanghai closes for Lunar New Year. 48 hours later, on February 12th, the Commodity Futures Trading Commission releases its weekly Commitments of Traders report. This report is public. Anyone can access it. It shows the positioning of different market participants, commercial hedgers, large speculators, small traders. What it revealed was striking. In the week leading up to Shanghai's closure, commercial traders, the category that includes bullion banks and institutional desks, increased their net short position in gold futures by 18,000 contracts. 18,000 contracts represents 1.8 million ounces of gold. At current prices, that's roughly $3.4 billion in notional exposure. This wasn't a gradual build. This was a concentrated positioning shift that occurred in the 5 trading days before the physical market went offline. Coincidence? Let's continue. February 13th, gold prices dropped 2% in a single session. Volume spikes during Asian trading hours, the exact hours when Shanghai would normally be providing physical bid support, but Shanghai isn't there. The selling pressure hits a market with reduced physical buying interest, and the price moves faster than it would under normal conditions. Stop-loss orders trigger. Algorithmic trading systems detect downward momentum and pile on. Retail traders see red on their screens and panic. By February 14th, gold has dropped nearly 4% from its pre-holiday levels. Now here's where it gets interesting. February 18th. The next Commitments of Traders report is released. And what does it show? Those same commercial traders who built massive short positions the week before, they've started covering, meaning they're buying back the contracts they sold short at lower prices. The trade worked. They sold high before the window opened, and they bought back low while the window was open. And they'll be flat or long by the time Shanghai comes back online and physical demand returns. This isn't speculation about what might be happening. This is documented positioning data published by a federal regulatory agency. The pattern repeats. February 2024. Commercial net short position increased by 22,000 contracts in the week before Shanghai closed. Prices fell 3.8% during the closure. Shorts covered during the final 3 days of the holiday. February 2023. Commercial shorts increased by 16,000 contracts pre-closure. Prices dropped 3.2%. Covering began 48 hours before Shanghai reopened. February 2022, same pattern, different magnitude, same directional bias. 3 years, 3 observable position builds, 3 price declines during the window, 3 profitable exits before physical markets returned. At a certain point, calling this coincidence requires more faith than calling it strategy. But here's what makes this particularly important for anyone actually allocating capital in these markets. This isn't just about what happened. It's about understanding what's happening right now. Because as this analysis is being recorded, we are sitting inside the 2025 window. Shanghai is closed until February 19th, and the setup is already in motion. The commercial short position was built. Prices have moved. Volatility has spiked. Right now, at this exact moment, there are 2 types of market participants. Type 1, those who see prices falling and react emotionally. They check their portfolio. They see red. They feel anxiety. They start questioning their thesis. They wonder if they should sell before it gets worse. They don't understand the calendar. They don't track positioning data. They don't recognize that what they're experiencing is a known structural event that happens with regularity. So they sell, and in selling, they provide liquidity to the very players who understand exactly what's happening. Type 2, those who recognize the pattern. They're not surprised by the volatility. They expected it. They've seen this movie before. They know that when Shanghai closes, the physical anchor lifts. They know that futures markets can push prices more freely during that window. They know that statistically, price tends to recover when physical markets come back online. So they don't panic. They position. Some buy the dip, some hold through the noise, some wait for confirmation that the window is closing before acting. But they're all doing the same thing, using the structure instead of being used by it. Here's the uncomfortable truth that no one wants to say out loud. Markets are not casinos where everyone has equal odds. Markets are information hierarchies. Those who understand structure, timing, and calendar effects have an advantage over those who don't. And that advantage compounds during periods of reduced liquidity and reduced oversight. The Shanghai holiday window is exactly that kind of period. It's not manipulation, it's exploitation of known structural conditions. And the reason this matters, the reason this should concern anyone holding precious metals or thinking about entering these markets, is simple. If you don't understand the game being played, you're not a player. You're the exit liquidity. So now we arrive at the question that actually matters. Not what happened, not even what's happening right now, but what comes next, and what that means for anyone making decisions in this market over the next 6 months. Because here's the reality that separates strategic thinkers from reactive participants. The Shanghai holiday window isn't just a short-term trading phenomenon. It's a symptom of something much larger, a structural shift in how global precious metals markets function, and more importantly, where power is concentrating. For the past 70 years, price discovery in gold and silver has been dominated by Western institutions. New York, London, Swiss banks, American futures desks. The rules were written in English, the major vaults were in Western jurisdictions, central bank gold reserves were held in New York and London. That was the architecture, but that architecture is changing. And the Shanghai closure windows, these predictable moments when prices whipsaw and volatility spikes, are early warning signals of a system in transition. Let's look at the numbers that matter. In 2015, the Shanghai Gold Exchange traded approximately 2,000 metric tons of physical gold annually. By 2023, that number had grown to over 20,000 metric tons. That's a tenfold increase in less than a decade. For context, global annual gold mine production is roughly 3,000 metric tons. Shanghai is now trading 6 times global annual mine supply every single year. This isn't a niche regional market anymore. This is the center of gravity for physical gold transactions globally. And when the center of gravity shifts, the old mechanisms stop working the way they used to. The futures markets in New York were built for a world where Western banks and institutions were the dominant accumulators of physical metal. But that world is over. China is now the largest gold consumer on the planet. India is second. Russia has been a consistent accumulator. Central banks in emerging markets have been net buyers for 14 consecutive years. The demand base has shifted east. But the pricing mechanisms are still concentrated west. That dislocation creates friction, and friction creates opportunity for those positioned to exploit it. Here's what's particularly important for business owners, institutional allocators, and anyone thinking seriously about wealth preservation in the current macro environment. The recurring volatility during Shanghai closures isn't just a calendar quirk. It's a preview of what happens when physical and paper markets lose synchronization. Right now, that loss of synchronization is temporary, 9 days. Then Shanghai reopens, physical buyers return, and prices typically stabilize or recover. But what happens when the dislocation becomes permanent? What happens when Eastern physical markets decide they no longer want to accept prices set by Western paper markets? This isn't hypothetical, it's already starting. In 2023, the Shanghai Gold Exchange introduced yuan-denominated gold futures contracts designed to compete directly with dollar-denominated COMEX contracts. In 2024, the BRICS nations began formal discussions about a commodity-backed trade settlement system that would bypass dollar-denominated precious metals pricing entirely. These aren't random policy initiatives. These are strategic moves toward a bifurcated global monetary system, where physical commodities are priced in one sphere and paper derivatives are priced in another. And if that bifurcation accelerates, if we move toward a world where Shanghai sets physical prices independently of COMEX paper prices, then everything changes. The volatility we see during holiday windows becomes the baseline. The dislocations become structural, not temporary. And participants who are positioned in the wrong market holding paper promises instead of physical assets or vice versa, get caught in a reconciliation event they didn't see coming. So what does this mean tactically for the next 90 days? First, recognize that Shanghai reopens February 19th. History suggests that when physical markets come back online, prices tend to stabilize or recover from holiday window lows. That doesn't mean prices immediately rocket higher. It means the structural pressure that allows unchecked futures selling dissipates. Physical buyers return, arbitrage resumes, the machines resynchronize. If you're watching prices fall during this window and feeling panic, recognize that you're experiencing exactly what the pattern predicts. If you sold during the volatility, you likely sold to someone who understands the calendar better than you do. If you held, you're now waiting to see whether the historical pattern repeats. Second, understand that this pattern will repeat every single year until the underlying structure changes. Mark your calendar, Lunar New Year 2026, Lunar New Year 2027. As long as Shanghai remains the dominant physical exchange, and Western futures markets remain the dominant paper pricing mechanism. And as long as those two systems operate on different calendars, this window will open. Sophisticated participants will position for it. Unsophisticated participants will react to it. The question is, which side of that divide you're on. Third, and most importantly, recognize the strategic direction of the broader system. Precious metals are not just investment assets. They're monetary assets in a world where trust in fiat currency systems is eroding. Central banks are accumulating gold at the fastest pace in decades. Emerging economies are building gold reserves as a hedge against dollar weaponization. Physical demand is concentrating in jurisdictions that Western institutions don't control. This isn't a short-term trade. This is a generational shift in how value is stored and transferred globally. The Shanghai holiday window, this seemingly small calendar event that causes predictable price volatility, is a microcosm of that larger shift. It shows what happens when the old system and the new system are temporarily out of sync, and it previews what might happen when that temporary dislocation becomes permanent. So here's the final assessment. If you're holding physical precious metals as a long-term strategic position against monetary instability, short-term volatility during known structural windows is irrelevant. You're not trading. You're positioning for a world where physical assets in your possession matter more than paper claims on someone else's balance sheet. If you're trading short-term price movements, then understanding the calendar, the positioning data, and the structural mechanics of these windows is mandatory. Ignore them and you're gambling. Understand them and you have an edge. But if you're still trying to figure out whether precious metals belong in your portfolio at all, then ask yourself this question. Do you trust that the current global monetary system, the one built on infinite debt expansion, negative real interest rates, and central bank balance sheets that have exploded by $20 trillion in 15 years, is stable? Do you trust that the dollar will remain the uncontested global reserve currency while the largest economies on Earth are actively building alternatives? Do you trust that paper assets will hold value in a world where the physical commodity backing those paper assets is being accumulated by governments that don't answer to Western financial institutions? Because if the answer to any of those questions is no, then the Shanghai holiday window isn't just a trading curiosity, it's a warning signal, a reminder that the system is changing, and that the participants who understand that change, who see it coming and position accordingly, will be the ones still standing when the reconciliation comes.